28 April 2023, Friday, MEO with Cal once again. Market rebounded, but is it a dead cat bounce? Now, the thing is this, the last few days we've been shorting the market and we make money. And yesterday I couldn't be online because I was having something on, but I think that those who watched my MEO video on the technical outlook, I did mention that do expect a rebound pretty soon, and it really happened. So the question is now, will this continue or will this be the turning point once again? So I'll tell you more in detail shortly. All right, disclaimer apply as usual, and thank you AIMS for the kind sponsorship. Right guys, today is your last chance to win a chance to go for this lovely lunch on the 3rd of May or Wednesday. All right, the Tomahawk King. All right, because tomorrow we will do the spin the wheel lunch with Cal segment after my preview. So that's why if you want to stand a chance to win this opportunity to dine lunch with me at this lovely place, and this place, where is it? It's at this 324 Changi Road, okay, lunch, then you need to listen to this video and this whole video and then comment in the comment box. All right, so that's very important. Okay, all right, so those people who have been given a thumbs up and the love button, you will be one of the lucky winners. Okay, one of them. All right, so we're going to invite 4 of you guys to join us for this lovely lunch. Okay, all right, let's recap what happened last night. Wow, the Dow Jones recovered 524 points. What a stunner. Nasdaq up by 353 points. Amazing. S&P up almost 80 points. So you can see across the board itself, right? You can see that Google, Microsoft, Apple up by 3%, Amazon 4%. That's incredible. But the one that really stole the thunder was Meta, up by 13.93%. That is really amazing. So what's the reason? I thought the earnings was not fantastic. That is my point. I'll tell you more in detail. But then again, let's see what CNBC had to say. Dow Jones and S&P up by the best day since January this year, and Nasdaq climbed by 2% as a big tech rally is okay. So what inspired the rally was because of Meta. Now, Meta shares leaped by 14% after the company reported quarterly revenue that topped expectation and issued an upbeat forecast. Wow. Several analysts hiked their price target following the release. Shares of other tech companies like Amazon, Alphabet, Microsoft, and Apple also popped. All right, so seemingly now everybody thinks that Meta is a darling, but wait a minute. Just a couple of months ago, everyone was downgrading Meta, remember? And one of the main highlights was Jim Cramer, right? So the thing is this, stock actually went out on a weaker than expected GDP figure. So that means that people are telling you that, okay, wait a minute, yeah, the GDP is not good. That means that the Federal Reserve will be soon wrapping up its tightening campaign. Huh? This is really ridiculous. So you're telling me now, when the GDP numbers are not good, it's because the Fed will loosen up soon. Then if the data was good, you say that, okay, Fed, although can do this, but the economy is doing well, let's continue buying. So regardless, whatever they say, the market just want to buy, they'll just spin off anyway to make sure it's a buy. All right, so to me, main thing is this, we all know that Caterpillar, another barometer of the global economy, fell by almost 1% because investors fear that the build-out inventory suggests demand is slowing. And this is real and accurate thing. So why Meta went up, right? I'll tell you in a very short while. Actually, it went up on a very incredible reason. So down to the bottom is this. Is the market to continue the upside, right? I really have my reservation. Let me tell you why. Now, this is how the chart looks like the last few days, and we've been telling our students, look, as long as the market stays below opening price, we just have to stay towards the sell side. And since the 33,900, we've been selling the Dow Jones until recent low. You can see that our students profited quite a bit, while nearly $1,000 over the last few days, and that is why you notice that TWB really acts on what we say. And of course, what's the main reason that drive the market down? We all know that it's all about the recession worries and stuff like that. So for today, we're going to expect ExxonMobil, Chevron to come out their numbers. It's supposed to be good. All right, yesterday with Amazon, Intel, Snap, and the rest. Okay, so let me explain to you now about this by Meta. Okay, so first of all, you can see that the share price of this Meta, which is Facebook previously, okay, all right, it came down all the way. Let me just take away this one first. Yeah, I'll try to show you something important. Okay, hold on a minute. Okay, Meta share, basically, as we know, since last year, March, has been coming down all the way from $240 It went all the way down to about $90. Okay, that was the lowest point, and was huge volume was being traded. And at the time, our dear Jim Cramer was crying and saying that, oh gosh, he made a mistake. Meta now is going to be doomed and blah, blah, blah. But from that very day, Meta share recovered 175% all the way until yesterday's high. Oh my God. Think about this. The share that in November was so bad that Jim Cramer had to call to be too upset about it. And now the share price up by 170%. Wow, what run is this? It's amazing, right? Okay, so what was the good reason for that? Let me show you to you now. So first of all, the company shares came out better than expected according to people, okay? And then the thing is that, remember, Jim Cramer was back in October. That was where the market plunged, right? That was where Facebook plunged all the way down from 123 to about $90. That's where Jim Cramer said, you know what? This stock is bad. He was wrong, and he think that this stock will go lower, but look at it. This is how Facebook replied. Okay, all right. So that is how it is, guys. Remember, just March back then itself, right? Remember when he said that Facebook is undervalued, right? That was March 2022. That was somewhere around here. So back then, the share price was at $200. So amazing, guys, amazing. When this part itself, he was going for 200 for upside. It did go up a bit, to be fair to him. But after that, the share plunged all the way. Then that's where he got himself upset and blah, blah, blah. So the question is, can this sustain? Well, let's just understand this. Okay, first of all, the EPS beaten by 30%. So that is what the market is focusing on, because it's like the last few quarters, right? The EPS, right? Earning per share was down by 3%, 11%, and 21%. So basically, you must understand that when $1 down by 3%, you get 97 and so forth, right? So when the market, when the last 3 quarters down by almost collectively about nearly 40%, to rebound by 30%, right? It doesn't mean that you recovered 2/3 of it. No, you must understand. From a share price from $1, if it goes down by 30%, it's at 70 cents, right? But at 70 cents go up by 30%, it's only going back to 91 cents. You understand my point? It's not equivalent. So to me, it's all right. Is the earnings better than expected, right? Well, it seems to be. But the thing is on the top of that, right, we have very ugly GDP, very ugly CPC data, very ugly housing data, and definitely the manufacturing was also bad. But the thing is this, Meta basically went up. So you can see that when the boys want to buy, they don't care about the fundamental. Who cares, by the way? So the thing is this, according to some analysts, they said that, right, Meta is up by 15% because their earnings dropped by 20% year on year, but because they mentioned AI 57 times, wow, during the whole entire speech. So that's the reason why people say that, okay, they are upbeat with the forecast, upbeat with the forward earnings, because now Meta saying that their AI is also almost ready. Wow, everybody into AI, yeah? So it's a little bit what we've seen back in 1999, the NASDAQ crisis. So other than that, right, let's put Meta away. First Republic Bank gone. Well, apparently we can see that the share really collapsed. Now, this is one counter. Remember, I was sharing this when the share price from 120 plunged down to $27, right? I draw this line there. I say, look, if the bank can stay above $27, we may see a bit of recovery, which actually happened. But I said before, once the market goes below it, that's it. The market, the stock will go down lower. And truth be told now, it closed below 20, closed about nearly $20 back then. In the next few days, you can see right now, wow, the share price is at $6. And there is a potential of it going down further to maybe $5. Oh gosh. So imagine, we just have this stock that was like in the March period was trading at 120 and now trading at potentially at $5. My goodness. That's how many percent is that? So I already said this is not going to be the only bank. There'll be more coming in. Trust me on this, all right? So that's the reason why now more than 180 of you guys have already decided to join my preview tomorrow. And a majority of you believe that we're going to see recession, right? Okay, so leading to this, right, let me tell you now, where do you think we are right now? Let me know in the comment box, okay? Now look at it. When it's rising itself, it's due to inventiveness, education, and good resource allocation. Then after that, when things are at the top itself, usually it's due to overextension, wealth gap. But when it's coming down, That's where large debt, printing money, internal conflicts usually happen. So which stage are you think we are now? All right, some people say we're stage 16 now, which is the Civil War and Revolution. All right, so let's see how it goes from there. Now, the thing is, we all know that yesterday the US GDP numbers was terrible. All right, it's really not good at all. And this is very clear-cut to why I say that we are very near to a recession. Okay, so let's hear what this guy from Bloomberg has to say to all of us.
Economic data out about 35 minutes ago. Mike McKee can break that down. Morning, Mike.
Good morning, John. I want to start with jobless claims because that's having an impact on the market. 230,000 after 246,000 the week before. It does suggest the labor market remains tight, and that is going to keep the Fed on alert. And the labor market being tight may have contributed to a stronger consumer spend in the first quarter than anticipated by many people. 3.7%, down from the overall estimate, but it is higher than we saw in the first quarter. GDP overall comes in at 1.1%. Now, people are saying that's weaker than expected, but the Atlanta Fed number that came out late yesterday pushed that number down to about 1.1%.
All right, you can see, guys, this is incredible. The first quarter of 2023 versus the fourth quarter of 2022 in GDP numbers, 1.1 to 2.6. This is not good, right? Although personal consumption have increased, but come on, guys, this is really not a fair engagement. Business investment has dropped quite a fair bit, and the change of inventories from $136 billion to now $1.6 billion. That's negative numbers. This is really, really bad.
Would have changed their forecasts had they had the time. Business investment really weak, and the change in inventories is what really moved things in terms of the first quarter. Subtracting 1.6 billion from inventories instead of adding, you can see how much was added in the fourth quarter. It exports little difference. The data basically say consumer spending is strong and consumers are hanging in there. Do they continue? Businesses don't seem to think so. Business spending dropped off significantly. Trade, little change, as I mentioned, but the inventories crash sets the Fed up for a question. If the consumer remains strong, the companies start building up inventories again, and then growth goes up, and that pushes on inflation. Or do consumers fall back to meet what business expectations are? Real final sales, 3.4%. That takes out the inventory aspect of it, and that suggests we do see some strength. Now, here's the chart that I promised earlier on surveillance, John. This is the Atlanta Fed GDP now. Never mind the numbers on the chart, although they were pretty close at 1.3%. But look at the trend. We started the quarter, came into the year on a high note, and ever since then, the economy has been slowing down. Does that?
All right, you can see very clearly what I'm trying to say here. This is really amazing. Now, start of January, we have a pretty good run until March, right? And that is where all the banks start to collapse because of the interest rate factor. And the thing is, that's why now the GDP numbers is coming down to 1.13%. And that's what I've been saying, guys. I believe that we will enter a contraction, okay, by August, September period. This is something that we are seeing, and it's obvious. And now, right now, you can see it's going to happen. So that's the reason why you should be very careful, because this is no joking matter. All right.
That's what we're going to see going into the second quarter and onward.
All right. So this is something that you should and feel it right now, that I'm not joking. In fact, this is where you prepare yourself. For those people who want to short the market, you can wait for your turn to short the market. For those who want to go long in the market, my personal suggestion is that this is a big cat bounce. So be very careful. Things can go really ugly. Because now the thing is this, that the thing is that now the unexpected outflows of the previous week is still ongoing. That means that there are more funds going out, entering into the money market. All right. That means that they take from the banks and they put into the money market. This is not a good sign, because that means that there'll be lesser money available for the deposit for the bank, and then the banks will really need this for their business. Definitely you'll get into trouble, and that's where more banks will start to ask for help. Okay. Now the thing is this, the Fed balance sheet, right? We can see very clearly right now. Let me just give you a moment. The Fed balance sheet, right? Oh, it's coming down at the same time. Now the thing is this, very interesting. The number shows that the Fed is shrinking for the fifth straight week by $30.5 billion. So that means that there's lesser support in the financial market. So you may ask them where the recovery yesterday came in. That's my point. If the Fed numbers are still coming down, and yet we have a strong recovery yesterday, that could be really a dead cat bounce. Okay, so that's the reason why I need to be very careful. Now, the real gross private domestic investment has dropped, okay, by 8.2% for the first quarter of 2023. And we can see that every time when you have a drop, look at the gray area, we will have a recession. Look at it. It didn't fail to produce that. Once the thing goes below, it will have a recession. The only one that was missing was about 1953. So not too sure what happened then, but pretty sure moving from there itself, right? When it go negative, we should have a recession, okay? Small little blip is not considered. I'm talking about at least substantially at -10, all right? So at -10, across the board, we are pretty nearby. So if you ask me right now, we are just very, very near to a recession, okay? So by August, September, we will see that recession. So because consumer loans and credit cards, look at the amount. Oh my goodness, guys, this is crazy. This is insane. Look at the amount, all right, of this credit card loans. Imagine back then in 2020 when we were at 440, and that was because of recession, and that was when the economy collapsed a little bit, right? So now where we are right now, we're spending more money on credit, and if interest rates continue to rise, you can think how much money you'll be paying for that. So this is really incredible, okay? So of course, people say that it's because people are spending, right? Or you just heard the consumer spending. Yeah, of course, if you buy cars, buy a house, yes, indeed, the numbers will go up, but the thing is, how are you going to pay? How are you going to pay for that with the interest? So the worst thing is now that the manufacturing index is coming down fast, okay? Look at it. It has came down so rapidly right now from 30 to -10. This is very bad because I mean production, new orders, shipment have all sank in contraction. And if if unemployment starts to really rise, this will even be worse. So all these speak for itself that there is something very wrong with the economy, but because the stock market failed to, or at least they try to make it look better, they pump the stock up itself, but this is going to likely be a dead cat bounce, yeah? So why am I very concerned? Because this is a very powerful chart. This is the drop, this is the transportation stock, and we all know that they are very good insights or what you call forecasts of the US economy. Now, copper has reignited the recession fear once again. Now, this is the copper 3 months rolling forward versus the Dow Jones transportation average, right? The one in orange is the Dow Jones, the one in black is a copper. Now you can see that the Dow Jones and the copper, they really move in tandem. So now the thing is this, if the copper price is coming down, so obviously we do expect the Dow to come off, right? Because the copper to gold ratio, you can see right now, we are now back again at the low end. So to me, all this is telling us that, right, there could be an economic hard landing coming in, okay? Rather do you think that this is going to like a turning point? No, hard landing and inflation is coming in at the same time. So all these speak for itself, and that's why now using the bear market probability model, we can see that the bear market probability is at a level never since 1950. Now this is taken from this sentiment trader. I cannot find much in detail, but if you look at it and you correspond it, right, every time when the data is at a high level, you can almost expect the stock market will pull back very, very soon. So that's why I feel that now we are just going to see the next sell-off in about a few weeks' time. All right, this is something that we can learn. But of course, at the end of the day, if you think differently, then of course, I mean, everybody has his own opinion and rights. Yeah. But for me myself, I think this is a good time to buy more VIX. In fact, when VIX came down to about 16, 17, we called for buy, and it went up to almost 19. Well, it missed the target by 20, what a waste, but it's okay. Our trading stop was triggered. So now it's back to 17, right? I think this is a good time to buy back in again. And of course, my target is still 22. And of course, if things go crazier, we can see even 30 by August, September period. What do you think, guys? So for me myself, I'm doing this. So let's see whether you guys will be joining us. All right. That will be all for today. And I'll see you on the technical side. This is Cal signing off. Bye-bye.